Greetings, market rebels. Welcome to this week's sector situation. It's actually Friday, October 20th, 2023, and it's about 7:15 p.m. here on the East Coast, but I'm traveling with my family this weekend, and so I've got to take care of this now because I won't have a chance to take care of it when I normally do on Sunday morning. So we're going to get right into it. We did take care of, excuse me, the macro measure already. Here's a trusty disclaimer. Here is our trusty intellectual property rights notice. And then here is the stream, this week's stream from macro measure, just in case you wanted to get a refresher or you hear me refer to something and you want to know where it's coming from. It's coming from this, changes every week in macro measure, and then we just flash it each week so folks have a chance to take a look at where we were in our thinking last week and then where we are for the upcoming week. So I think that's long enough. If anyone wanted to do a screen cap. So let's just see if we can quickly reposition things. And I'm going to need to go to different screen now. And that would be screen number 1 in this case. All right, so I think we are here. And so this is sector situation. I just wanted to start out with TNX because this has been our big watch. This, along with the dollar heading higher, this is really the thing we've been harping on for really since the start of 2022. But yeah, as it's become more and more, I think, salient, we've tried to really hit on it, and it seems to be impacting more and more. And you're seeing that really in the equity markets. And so this relentless surge from TLT really is a good way to see how bonds have been sold off, which has caused yields to rise. It's pretty severe, really very substantial, right? And just relentless. So this has really been a big driver. And I wanted to start out just by emphasizing that. So what I'd like to do now is do our quick flash of the sectors. Now we usually start out with a view of the 12 sectors, and we're doing that here. And I'm going to go to the individual charts quickly. On each one of these, I'll move these out of the way. But what I wanted to show here really was two main things. One is we're getting near the oversold zone on most sectors. We're not quite there yet. So I think one final whoosh lower would bring about that oversold condition across the board. We're just not there quite yet. We've been close at times, but never really have gotten there since the strong bull market-esque performance launched last October into July and through July of this year. So we really haven't been this officially oversold across the board. In other words, like a major risk off phase that could be coming. I think it should come. If there's a week for it to come, it would probably be this week that's upcoming, and then they maybe would position themselves to try to improve things from there on out if possible. But again, with rate, who knows what rates will do. If they back off, that would forestall things. If things somehow tensions decline in the Middle East, that would probably help buoy U.S. equities as well. Let's see. The other things I would want everyone to take notice of is really this column. And they did start to sell into energy a little bit, little profit taking there at the end. That's at the end of the week. That's been a strong sector for obvious reasons. There's a lot of things going on there that are particular to energy, and also the geopolitics have been playing into that naturally, like they typically do, but just maybe in a bigger way. But really, it's been looking out for this XLK and XLC to come under pressure and maybe on their way down to threatening these key lows. And that started to really flare up again. So risk off across the market pretty much. And now even these darling sectors that have been really the stalwarts that refuse to fall, they could really be getting back to where they are at that key level very soon. And that could be the beginnings of maybe real risk off, a real serious selling phase that we see. And without that happening, I don't think we'll get there. So because I've got to get this covered tonight, let me try to get right into the individual charts. Let me move things away so I can just have a quick reminder on things of where we need to go. And so we just double check on our share that it didn't shift on me, and it didn't, and that's good. So let's take a look at those sectors, and then we'll start moving on to others and related ones. So here's energy, and you can see that it did have a great run. Right now, it backed up on Friday with some profit taking. I've had a line there, which I'll now extend. Oh, I don't have the pointer. I've got the hand, so I've got to move over to pointer. Thinkorswim. And it's still not letting me grab my own trend line there. All right, there it goes. But here's where I would extend it to. And I think it's come back into there. So you've got all those SMAs and that now theoretically a support line potentially at least there. So it should, right, if the bull's intact there, that should really not fall too far below the 20-day, and that would be 89.32 right now. So there's very little downside there in theory, right, if that's going to stay really strong. And there looks like there's a flat line there on top of it. So if it's below 89, that's probably for some other reason, some really good other reason that it's acting that bearishly. It really should hold somewhere around here. There's a lot of forms of support there, but that's its own special situation. The long-term trends are still up as well. Short-term trends are trying to fix themselves based off of the last 2 weeks of action. So that should really hang in there overall. Let's see if I can just move some things around, and that's going to be one of them, just to keep an eye on things. And I do think the trends are definitely intact in that one, and I just wanted to double check. So the trends are intact there. So I'm going to move on to the next one. We can't really analyze these things fully. Each individual one, we're kind of more or less trying to draw at this point with the phase we're in now in the market is some interesting observations from what's going on. And this is obviously one of them, with the darling of darlings being XLK now at the 150 in Rust there on the daily. So this is at jeopardy, at risk of losing the longer term uptrend, which shouldn't happen, right, if you're in a bull market like so many have claimed that we are. And I'd say in some cases rather arrogantly, but that's usually the case anyway. Don't know if we are in one, but I think this thing losing the 150, taking out this low, setting up a test for the 200. This is similar sort of to what we thought would happen in the SPY with this weaker rally result. Last week, we got that test of the 200. Today, we don't know what the outcome will be in SPY, but that would be similar, right? If we go risk off, I would expect this to finally come under serious pressure. The test the purple 200 could be in order if there's a really strong week of selling. XLC is one of the other darlings. It may have even been more of a darling in some ways at some points in time, but recently it's hung in there better. I would say that it's kind of more of a sideways consolidation rather than putting in lower highs. So we got to give it that nod, but clearly right above the 100 there in dashed white. That is right above a couple of lows. There's definitely a flat line on Ryan's charts, I would guess somewhere near, if he's updated this one, somewhere near there, but I can't even tell you where because Thinkorswim switched me over to percentages again. And I don't know why it does that, but it does it. So that would be around 65-ish, we'll ballpark it. Probably a flat line right near 65 in this one. So if you see that thing losing that, that means you're probably on your way to this 150 at 63.66. That doesn't hold. You're probably on your way down towards the 200. And again, if you do get risk off, that's exactly what I would expect that you would, maybe not in this week, but if that became a really serious risk off phase, we've got another really strong down leg that we embark on. That's when these things really should follow the major index ETFs lower. But remember, the big wild card coming up is immediately in the future is the EPS of the mega caps, super mega caps. A lot of those are going to hit the tape this upcoming week. And then you're really with a stone's throw away from Powell and company doing their thing the following week on November 1st, I believe, which normally would be right a Wednesday when they make the announcement and then all the shenanigans take place. But it could be different this time. I didn't verify that, but I would bet that it's probably on a Wednesday, which would be Nov 1. Anyway, here's your XLF. This is really the site of the crime so many times in market history, right, where there's just problems developing. And again, there probably are problems developing here, and that could really shake, rattle, and roll things. I think the trend there is also definitely in jeopardy. So if they don't really finish this month strongly and save these things, resurrect these things from where they are or worse, they're inviting more technical selling. So we're really at a big critical time. You can see KRE took a really serious turn for the worst related to the XLF. You've got downtrending long-term SMAs here. You've got the same in the shorties. So this is definitely looking challenged, to say the least. This is a really poor technical complexion to have. That doesn't surprise me. You've heard probably Ryan and I all year long saying we've been in this thing. We were in for the initial swoon, and we then got in again, and or should say extended it and modified things to be in it again. I got out of it. I think Brian might be still holding it, but I'm thinking about initiating something. I've just been too busy. But this is a great risk of also taking the turn for not only for the worst, but also of taking a turn for really the longer term trend change. That is not good at all. Here's transports, always an important one in my book. Like I said, the RSIs on a lot of these are down there, but not quite an oversold territory. So one really ugly phase could bring that about. It's near the lower Bollinger. You can see that the lower, shorter term SMAs have really rolled over. This does not look, that's not my thing, but I know a lot of people follow it. And so that's why I mention it. But this is rough stuff here as well. And it's hard to like that chart other than the fact that the sellers have dominated for so long that maybe there's a change or of the passing of the baton that's due. But honestly, that looks quite bad. And I always consider that to be a very important sector, right? If goods are not flowing through the economy in a healthy way, and these companies aren't doing well or aren't set to do well, that's not a good thing. So this is getting down there. This kind of has been a leader on the downside. So this might run its course and find a low if there is to be one soon before other things. So keep your eye on that. But right, we are not early to this party at this point. And with the RSI at 35 on the daily and sellers fully in control here, you can still trade this downtrend, but you've got to realize you're near the lower Bollinger, your RSI is getting there. Again, in risk off where all hell's breaking loose because of whatever geopolitical developments or otherwise, this would be something you could still trade from that side, I think. But you have to be careful when you're late in the latter stages, when you're in the latter innings. You always hear me say that. But again, for newer folks, I like to put these reminders in when I can. XLV, this would normally be, right, a kind of defensive sector. Go into healthcare. It's holding up better than others, clearly. So I guess it is serving that role, but it's not like it's looking good at the moment. Also, another one that is at risk. Virtually all of these are at risk of really shifting to a bad longer term or poor longer term complexion. And that means, in my mind, that means that there's unlikely to be really good times for stocks in the very near future, meaning that over the next 3 to 6 months, things might not be as rosy as a lot of those bulls that were buying in May and June and July thought things would be, and that could end up really being a bull trap and could create more selling, right? You could finally get chased out. Staples, this has been an ugly sector that's just gotten destroyed. It almost looks like right now that it's set. The RSI bounced back up because it got so oversold, but it's almost looking like it's ready to take a test of those lows, right? So again, you would expect that if the whole market goes risk off. Sellers have been in control of here for a while. They remain in control of here. It's just a question of, do we put a higher low in? Do we have a set of similar lows or a similar one-off low? Or a slightly lower low, or do we just keep going, right? Those are your possibilities. So what do you get here? And I think that to put things more in line, there should almost be like a washout phase to kind of bring things closer to reality and maybe set up more of a rally potential for the end of the year, the way that the presidential cycle calendar calls for one. If I'm a bull, I probably would prefer to have the next 10 days to be pretty damn ugly. And then I get that out of its system and I try to create, largely artificially, but still create more of an end of year rally effect that makes the year not look so dreadful. Anyway, that is the view on the staples. The view on discretionary, which was really hanging in there. I guess people continue to spend, on stuff that is really a discretionary purchase. But finally, right, that these are some of the economic realities, I think, that we've been harping on, saying that we think it's just not that great out there. And that seems to finally, in the past few months, be recognized ever since, right, they made everything look incredible during the earnings season. So it's been ugly really from there, right, during that earnings season. And now, right, this is getting really rocked. So this thing's at 31 on the RSI. You haven't really had a complete return journey to where it broke out from. I would put the breakout in here. So there is a little more downside. And that kind of fits with what I'm thinking really should happen. Again, not predicting will happen, but I do think there should be more downside next week. The wild card is those EPS, like I said, and then the anticipation. But if you get really overdone and you have a really serious risk off phase, a really serious sell off, something that gets cascadey, you got to be smart about that and just keep rolling with it. And then once you see those momentum turn, close those out, and be happy that you caught the tiger by the tail for a little bit, because with the Fed maybe pausing the way the markets expect, that could be the kind of thing that they could try to use to celebrate, right? Really create a really good, that's some good squeeze fuel. Everyone should see that coming, I think, but there's people that don't. Time and time again, this has got a gap down here, XLB. As I said, this was hanging in there for a while, and it kind of had me scratching my head because of what I think is happening in the global economy. How are materials doing well? They were hanging in there. We have to give them credit. But finally, again, I think reality has crept in there. Definitely close to oversold, below the lower Bollinger. That doesn't bother me so much simply because the Bollingers are relatively narrow. It's not like they got outside of the Bollingers after they've been super widened. So that doesn't bother me, but we have to concede, right, that even if you're a dyed-in-the-wool bear, there are lows just below here, right? Many lows, and that's kind of where it broke out from. So it all makes sense. So again, if this thing finds support down just a little bit more, I'm talking like another 50 cents to $1, it's not a big mover. You've got to appreciate that, right? It'll be oversold. It'll be this, that. Sellers fully in control here, though. I mean, and if it closes down here, again, I think the challenging times remain for this sector as well. And that's what I'm seeing. I'm seeing all sectors, really the quick look that I had right before cocktail hour. I noticed this. That's why I made a mention of certain things on cocktail hour. This is not a good development. These are not good developments for the market going forward at all, because so many things are now likely to be under pressure or really not in a, let's put it this way, there should be an absence of a really strong, persistent, resilient bull phase. In most cases, I would expect that to be absent for a few months at the very least. So that makes an end of year jam job, it's seemingly a taller task, but we've seen these guys pull off miracle after miracle. So don't count them out yet. Another one, right? XLI, kind of the same thing. I was thinking, how are higher rates helping this, given how expensive so much of this is, and the financing involved? Well, there you go. It finally, much like XLB, reality finally kicked it in the behind, and it's getting prices getting adjusted accordingly. The global economy just isn't firing. Europe, China, that the reports just aren't good. And I think here it's always way too much happy talk, but the happy talk is even having a hard time for a change, right? So a lot of the normal suspects that just can't let the truth come out of their mouths regularly, they're struggling to find great things to say. XLU, we just cover this to be thorough. We know this isn't really our trader, but usually, right, this is normally a sign of defensive. You see defensive shifts into here. It maybe hasn't gotten walloped naturally, but it's not a volatile area. That's why, of course, it's one of the reasons considered defensive. But I think the problem here is yields rising is kryptonite for this, right? Because of what happens and how how those monopolies, how those utilities function. So they do a lot of financing, and there you go. You're struggling now because rates are so much higher, so much faster. So let's just do a few quick checks on things. The futures in oil, they did not really jump the way XLE did. So going back to that. So we've seen really that be the case, and it seems like a lot of times XLE does tend to get out ahead, and then the crude will catch up to it. But every now and then, right, the XLE is going to catch down to crude. So that's interesting to keep an eye on. But yeah, the CL, right, it did not really fire. Wow, I'm getting a little hesitation here. I'm not sure why I'm getting so much. Suddenly Thinkorswim's really hesitating. I might have to get away from this future. But anyway, there you have it. That's probably got a little catch up, unless, of course, XLE is finally going to take a breather and back up a little bit more. We don't think there should be much there, but maybe there will be a little bit more than we expect. I got to cover these. XHB, right? This has been one that we have had bearish ideas in that based on UOA, and I resisted it for the longest time, but I sort of like got into here and couldn't help myself. Despite these trends, I decided I had to get some of these in. So we got some in there. We got some in XLI, I think about the same time. That's my memory, but that's finally, that's finally come into line, and that's good. I mean, for the folks that are trading that in UOA Pro and the other services we have it in, but you can see that's gotten pretty close to oversold. It's outside of the Bollinger. It got down below the 200, but a little reality crept into that market. I mean, I don't care what's happening right now, right? I've been thinking about how just this all ripple effects out in there, given how important financing is. But this was the week where real estate finally had the cold shower and the hot pot of black coffee. This is like they tried to do the normal shenanigans from oversold here, and it just got sent packing, right? So there's your commercial real estate. So that was rocked. The cut and wood, they were finally rocked, and we were saying, like, what's going to happen here? They're not doing much. Are they finally going to reflect what's happening? And they did. You can see that there's cut that got hit pretty hard this week. I'll probably give us a little bit better view on some of these, since the bigger picture charts aren't as important right now. I think with everything going risk off in this particular area, you kind of get the idea that what's driving that, with the yields and inflation, like high prices, high interest rates. Yeah, that's just not a good combo for this stuff. Cut and wood, though, if both those ETFs we've been using since we couldn't get our hands on the lumber futures, those have been, they just probably one of the worst weeks they've had in a while, right? So that's some ugly stuff. That started to reflect reality more. Commercial housing is reflecting it more. Remember, this is all a function of what I covered in the other video, I think, with TLT, with bonds getting sold off, yields rising the way they have, virtually like very strong move, nearly relentless at times. So this is all obviously, right, the Fed's part of this, clearly, right, a big part of it. So what's happening and why this, but some of these sectors were trying to act as if they were immune. And one thing that kind of hung in there, we were saying, like, we're not trading copper, but they call it Dr. Copper for a reason. And we were saying it's hanging in there pretty well, given that the whole world seems to be, in sync in terms of economic slowing. And, that's not normally good, right, for copper demand, copper being such an important metal in that respect. And you can see that's finally back towards lows. So that even had that kind of reality check as well. And it's not really taking out that low is very close here to this low way back when, but this slightly exceeded it. So that's really trending the way that I would expect it to, frankly. The other thing we should cover quickly is the metals. And I said, I thought last week was very important. It just struck me as a very strong move that we should, and given maybe what's behind it, right? There's a lot of factors that could be behind this. We said 2,000 in gold is what we wanted to see, to really start thinking more about the longer term, but that there was maybe still a short-term trade in here for now. We have put ideas in the services that are alongside ideas in several names in the space. So that did hang out there, but remember, like that did get hit right at the 100 SMA and XAU, and it's kind of held in there. Now it's had a great move off the low, so you really can't fault it, excuse me, if it drops back down to the 50 there in gold and with a rising 10 or maybe a little further. But remember, that can be a tough sector to trade. So once again, I would advocate being smart about what you do. And if you caught that run, a good roll up isn't the worst thing that can happen, especially if it goes down, right? So here's just a tremendous move. It does this at times, and then you can get a lot of quick backup in here, right? So just be careful. These still, I think, have the long term in front of them to tackle. They are not long-term buys in my book yet. I wish they would not even get close to that, but I'm not going to chart it that way for everyone else, right? I want it to come down so I can buy more of it. It's a hedge for my family, but I still think these are challenged long-term, but you got to admit, right, that it did have a hell of a run, maybe got a little short-term overextended right now. So you got to be careful just in the short run, but a little bit of a pullback there wouldn't hurt it. And I think it would still probably try to go up as long as these situations unfold. But right, this thing could be up. It can all be up big, though. We know that simply because you could have major developments, and that would really lift this immediately, right? When people hit the panic button, So you can see that all these things, like all the ETFs we're looking at, right? These are various ones that are out there, but they all have a very similar chart. There's nothing I could say that's a nice little technical thing that would be like, okay, this is a nice little wrinkle that we can hang on to, or let me just note this for you. They're all virtually identical, right, in terms of their overall shape and what they've done over the past few weeks. So they're just all not out of the woods. And that's the best thing I can say about them now is they've had a good run. I mentioned GCZ23. This should give me the gold future. And I've been saying, right, the 2000 area is what this has to get through convincingly. And that future traded up through there, but notice, right, it was not able to close above it. But that's where I think if you can get above here and start holding 2000, that's when this gets really serious. And I think, right, naturally, you can't really take it too seriously until highs start to get taken out. When highs start to get taken out, then you could say, man, this thing's taking out highs. This is now, really serious in terms, and that's serious not only for those markets, the precious metals markets, but it's very serious, right, for what that portends for other things, because usually when this thing's having a hell of a run, it's not good. So again, another sign, I think, from price action in a key area is telling us, right, that there's real risk out there. The VIX is showing, I think, finally that it's on the launch pad. The VIX is notorious for firing at times in a spectacular fashion. It's also notorious for exploding on the launch pad and retreating more often than not. So again, you got to be ready, but I think you're really close to something that's really big from all the stuff that we looked at. We did take a look at so many things. I'm trying to think if there's anything we normally cover that I left out. But even XBI, we covered XHB, we covered the commodities. I think we've covered everything. So I'm probably going to end on that. But I think the real takeaway is that, you're clearly going risk off, right? Let's not forget to restate the obvious. You're clearly going risk off. And one awful week or week and a half of awfulness before the Fed could be the thing that flushes it out of the system, where you get that cascade, it kicks in. You get a real smoke job, right? That this market gets smoked. Things get really oversold across the board. It's the right time of the year for the gang to embrace that with open arms and then go to town. You'd start to see lows typically get put in somewhere late in Oct, early Nov, and then it's a little dicey for a while. And then once they get their hands on stocks in December in this third presidential year, they should move a lot of their sectors up. Remember, the ones that have gotten annihilated probably have a bounce, and the ones that have hung tough, they probably catch a bid and they power right back into them, right? And then you have to wait and see, of course, but that's usually what I look out for. So I'm going to end it on that note. I'm going to wish everyone a wonderful weekend. By the time you watch this, it might be mostly over. So I hope you had a great weekend by the time you watch it. A great finish to your weekend. Hope something I've shared with you in this video helps you out in this upcoming week or some week in the future. Thanks for tuning in, and get your game face on for next week, because the next few weeks, I think you're definitely going to need it. Thanks again.